While 2022 was the year of the value investing rebound, 2023 was just the opposite, the year of the Magnificent Seven. This recent dominance of mega-cap growth stocks has created an opportunity for investors to profitably rebalance their portfolios towards less expensive, underpriced names. That said, bluntly picking stocks with cheap valuation ratios is likely to prove suboptimal, and a more selective approach may well be warranted. In this article, we show that among the most underpriced names, there are many that are cheap for a reason, cheap and getting cheaper, and worst of all, potentially insolvent. These value traps are very detrimental to deep value investors, and the avoidance of these situations creates better upside and lower risk. But how does one do that? We show some simple ways to improve value investing results by removing the value trap names. We first identify poor quality companies, defined as companies with too much debt or companies with poor capital discipline. Cheap stocks with low quality are often cheap for a reason and sometimes potentially insolvent. When these low quality companies are removed from deep value portfolios, returns improve and volatility drops significantly. We then identify falling knives, defined as company with poor risk adjusted momentum. These stocks are often cheap and getting cheaper and also sometimes potentially insolvent. When falling knives are removed from deep value portfolios, we see similar return and volatility improvements. But the most powerful impact is to use both quality and momentum in conjunction. Because quality and momentum capture different aspects of a company's risk, investors can more effectively avoid all the value trap situations: cheap for a reason, cheap and getting cheaper, and potentially insolvent. In the deepest value portfolios, this approach improved returns by 2.7% annualized while reducing volatility by 2%, creating superior risk and return outcomes.